Okay, the part three is the management of the translation exposure. So how to manage this exposure? And the translation exposure is not, I mean, it's somewhat related. Is actually transaction exposure. Sometimes they come together, or sometimes not. Sometimes they can actually just eliminate both or one of them. So there's the example here, Exhibit 10.8, present the transaction exposure report for the company's name, Centralia Corporation, and its two affiliates. Okay. The items that create transaction exposures are receivables and payables, usually, that are denominated in a currency other than the currency in which the unit transacts its business, or cash holdings denominated in a foreign currency. So that's basically create the transaction exposure that we learned last class. And from this table, we can see that the parent firm has two sources of transaction exposure: cash and not payable, right? So the first one is this Canadian dollar, 200,000 deposit that it has in the Canadian bank. If the Canadian dollar depreciates, the deposit will be worth less. So US dollar based the parent company's consolidated financial statements, the value declines. Now you can see the $3 million Mexican peso, PS is a pesos, account receivable. The parents hold on the Mexican affiliate is also the transaction exposure, but it is not translation exposure because you can netting intra-company payable and receivable. So the exposure amount is net amount, not so like a one by one separately. So you can netting like intra-company payable receivables usually, and these receivables probably does not have any translation exposure. Now the third part is 375 Swiss franc notes payable that Spanish affiliate owes to the Swiss bank is both transaction and the translation exposure. Okay. So that's the example of this exposure. Now, it is generally not possible to eliminate both of them. That's a big problem. If we can eliminate both of them, then that's easy, but sometimes we have to choose one of them. Transaction exposure usually involve the real cash flows. So we usually believe that the transaction exposure should be considered the more important than translation exposure. So the financial manager may not want to create this transaction exposure because of the effort to eliminate translation exposure. Okay. So this is another table, the revised translation exposure report for Centralia Corporation and its Mexican, and Spanish affiliates. So this Centralia Corporation and its affiliate can take a certain measure to reduce its transaction exposure and to simultaneously reduce this translation exposure. So one step the parent company can do is to convert its Canadian dollar cash deposit into the US dollar deposit. And then second, the parent firm can request payment 3 million peso owed to it by Mexican affiliate. And then third, the Spanish affiliate has enough cash to pay off the 375 Swiss franc loan to the Swiss bank. So the parent company actually can act like the convert Canadian dollars first and change to US dollar and then make a deposit, okay? That's the first thing they can do. And then what they can do is they can request this payment of the 3 million pesos, and then Spanish affiliates should have enough cash to pay off this Swiss franc debt. If these steps are taken, all transaction exposure for the multinational company of the Centralia, right? Centralia will be eliminated, right? And also the translation exposure will be also reduced. Okay, and this table actually show that. So this table show that there's no longer translation exposures associated with the Canadian dollar or Swiss franc, right? Because you see, and there's nothing exposed amount Swiss franc and Canadian dollar. Additionally, this table shows that the net exposure has been reduced from 25 million pesos to 22 million pesos, and euro basis from 2.101 million euro to 1.826 billion euro. Okay. So this type of the activities actually may reduce the translation exposure, but more importantly, they have to try to eliminate transaction exposure first. And if the transaction exposure increases because they try to minimize the translation exposure, then that's not a good choice. You choose eliminate transaction exposure first, and then translation exposure is the next one, actually. So how to hedge this translation exposure? The first way is called the balance sheet hedging. They just try to eliminate these mismatches. Mismatches between what? Net assets and net liability in denominated in the same currencies. This try may create a transaction exposure, however. So balance sheet hedges basically can be seen in the previous slide here. So this is how they use. So they basically change balance sheet to euro, right? So there are 1,826,000 euro more exposed assets and liabilities. If the Spanish affiliate, or more practically the parent firm or Mexican affiliate, had 1,826,000 euro more liability or less asset denominated in euro, there would not have any translation exposure with respect to the euro, right? So the amount of exposed is like here we can see the in euro, and if the other affiliates or the parent firm has enough asset to cover this exposure, then they're fine. A perfect balance sheet hedge may be able to be created. So that's called a balance sheet hedge. They just match between the net asset and the liability in same currencies. However, this may create transaction exposure. So the other way is they can use the derivative securities. So they may use the forward contract with a maturity of reporting period to attempt to manage the accounting numbers. And if they use this derivative hedge, then they may not be exposed by transaction exposure, okay? But however, there's some risk. So using a derivative hedge to control translation exposure really involve speculation about foreign rate changes. However, it means that if the foreign exchange rate changes, you use the derivative security, optional forward, sometimes swaps, and so if your foreign currency changes, like exchange rate changes, like in the opposite way, not expected way, then you actually are exposed to very high risk. So translation exposure versus operating exposure. The effect that an anticipated changes in exchange rate has on firms' ongoing operation, right? So that's called operating exposure. It's very serious issue, right? Because this is about the operation of the firm. So unhedged depreciation in euro, for example, will result in equity loss. Such a loss, however, would only be a paper loss, right? It do not have any direct effect on reporting currency cash flow. So the translation exposure is basically just paper loss. It's not really the cash flow for local currency, reporting currency. In addition, it would only have a realized effect on the net investment in the multinational companies if the affiliates' assets were sold or liquidated, right? However, the depreciation of local currency may have favorable operating effect, right? So operating issue, you may have get benefit from these depreciations. A currency depreciation, for example, may allow the affiliate to raise its sales price because the price of the imported competitive goods are now relatively higher. So you can get benefit from producing in the countries that has the depreciated currencies, right? If the costs do not rise proportionately and unit demand remain the same, the affiliate would realize an operating profit as a result of currency depreciation. This is about operating exposure. And it's very important issue because it really changed the cash flow. It really changed the cash flow. So the management should concern this issue very seriously, very seriously. So the chapter 8, 9, 10 actually explains about the different types of the exposure and how to manage this exposure, like the risk about the foreign currencies. I mean, this is kind of very important because for the multinational company, they need to control for the risk from the exchange rate changes and based on the different types. Each type has different characteristics, so there's a different ways to control. Okay, so that's the end of the chapter 10, and thank you for watching this chapter 10 video, and see you in the next chapter.